Welcome back to our market close coverage. Let's dive right into the numbers. The Nasdaq closed at 25,818.69, down 1.16%. The S&P 500 settled at 7,503.85, a loss of 0.45%. The Dow Jones showed relative resilience, ending at 52,925.15, down just 0.25%. Market anxiety ticked up, with the VIX rising 3.6% to 16.13. The 10-year Treasury yield continued its upward climb, gaining 1.12% to 4.53%. The dollar index edged up 0.21% to 101.12. The offshore yuan held steady near 6.8031 against the dollar. Bitcoin slipped 1.09% to $63,542. In commodities, WTI crude surged 4.68% to $72.47 a barrel, making it the strongest performer today. Spot gold edged down 0.59% to $4,109. Today's market can be characterized as a choppy, risk-off session with clear divergence. Money flowed into commodities, particularly crude oil, and cash positions. Here is why. The VIX rose while the Nasdaq suffered the steepest decline, signaling pressure on risk assets. The rise in the 10-year yield further weighed on growth stock valuations. While the Dow held up relatively better, overall risk appetite was clearly declining. Capital moved out of technology and emerging markets, with some flowing into real assets like oil. Gold's slight dip suggests there was not strong conviction to hedge against a stronger dollar. Let us walk through the global trading day. During the Asian session, disappointing second-quarter GDP from a major emerging market economy weighed on stock indices across the region. Sentiment was cautious but without panic selling. In Europe, the ECB president delivered a hawkish speech, signaling that high interest rates would persist for longer. This directly hit European equities, with financial and real estate stocks leading the decline. U.S. markets opened lower, with the Nasdaq posting the biggest drop. The S&P and Dow declined more modestly. There was no significant rebound during the session. The VIX climbed above 16, and weakness persisted into the close. The energy sector bucked the trend, rising on minor geopolitical tensions in the Middle East. However, overall trading volume remained subdued. The key inflection point today was the ECB president's remarks, which transmitted risk aversion across global markets. Compared to our morning assessment, we correctly anticipated a weak tone with declining risk appetite and structural divergence. The pressure on the Nasdaq, the rise in the VIX, and the higher Treasury yield all played out as expected. However, we did not foresee the strength in crude oil, which surged 4.68%. We had underestimated the geopolitical risk premium from the Middle East. The biggest surprise was that markets largely shrugged off the potential for sustained selling after the ECB's hawkish comments. U.S. equities only fluctuated modestly into the close without accelerating losses, suggesting that some of this information had already been priced in. Looking at the three-way between currencies, equities, and bonds, we saw a broadly bearish today. The dollar edged higher. The offshore yuan traded narrowly around 6.80, indicating a differentiated view on emerging market risk, with China appearing relatively stable while other regions faced pressure. Both U.S. and Chinese equities declined in the same direction, confirming a synchronized global response to growth concerns. The rise in the 10-year yield combined with falling stocks created a classic stock-bond sell-off. Higher rates pressured growth stocks, while growth worries were not severe enough to trigger safe haven buying in bonds. This combination of a stronger dollar, higher yields, and falling equities is typical of a risk-off environment, though not an extreme one. For Asian markets tomorrow, this implies continued pressure on tech stocks, while defensive sectors like high dividend and utilities should hold up relatively better. Sector-wise, energy was the clear winner. WTI crude surged 4.68% and Brent rose 4.83%, driven by Middle East tensions and supply concerns. The next strongest area was AI infrastructure bottleneck materials. EMAS jumped 13.45% over 2 days, and AXTI gained 12.19%. But with growth stocks under pressure overall, these moves appear more event-driven and their continuity needs confirmation. The weakest area was technology and growth stocks. The Nasdaq fell 1.16%, the QQQ lost 1.51%, Tesla dropped 3.38%, and ARKK declined 2.74%. The dual headwinds of rising rate expectations and falling risk appetite were the primary drivers. On individual stocks, a few points stand out. For opportunity candidates, EMAS is worth watching. Strong demand for advanced packaging and AI chips is a positive. While profit-taking may emerge after the 2-day surge, the structural opportunity remains. A small position could be considered on a pullback to near-term moving averages. For portfolio holdings, the Japan-listed stock related to indium phosphide showed relative resilience. The logic as a key material for high-speed optical communications remains intact. The stock is above its 200-day moving average and still has room for recovery. It can be held without adding. For risk avoidance, Akoustis Technologies is a name to exit. With a very high short interest ratio, the stock is vulnerable to short selling pressure in a corrective market. The upside and downside risks are asymmetric. Regardless of profit or loss, closing the position is recommended. Here are a few verifiable predictions for tomorrow. For Asian markets, the CSI 300 index is expected to trade choppy to weak, with a range of down 0.5% to up 0.3%. The core drivers are continued weakness in U.S. equities and lingering emerging market growth concerns. However, the A-share market has already fallen 1.03% today, so some resilience or a shallow bounce is possible. The 10-year Treasury yield is expected to trade in a high range between 4.45 and 4.6%. The market needs to digest the ECB's hawkish message, and with no major data tomorrow, yields could pull back slightly. The energy sector, tracked by XLE, is expected to remain firm in a high range, with potential gains of 0 to 1.5%. Middle East tensions have not subsided. Spot gold may see a modest bounce, trading between $4,090 and $4,150. To summarize tonight's strategy. Overall portfolio exposure should be reduced to 45% of risk budget. Holdings should focus on energy ETFs and a small position in AI bottleneck materials, hedged against the Nasdaq. If WTI crude does not break below $71 before the open, maintain long energy positions. If global equity futures stabilize before the U.S. Open, a small addition to defensive high-dividend stocks is possible. However, if the VIX breaks above 18 and Nasdaq futures fall more than 1.5%, the strategy should shift to net short or cash. If the S&P 500 breaks below 745.80, its 200-day moving average, the corrective market may escalate into a bear market, requiring broad stop-loss and reduction. Our probability assessment for tomorrow is 20% for an up day, 35% for a sideways day, and 45% for a down day. Overall, the market faces near-term headwinds, but structural opportunities remain. The key is disciplined position sizing and selective sector focus. Thank you for watching. We will see you tomorrow.